What if I told you that the most financially responsible decision of your life could actually destroy your reputation with the banks? Imagine you have worked hard for years to pay off a massive car loan or a student debt. You finally make that last payment, you celebrate being debt-free, and you expect your credit score to skyrocket as a reward. But then you check your phone, and the number hasn't gone up. It has crashed. You did everything right, yet the system punished you. This isn't a glitch. It is a feature of a game you are playing without knowing the real rules. Most people believe that a credit score is a report card for how good you are with money. That is the first and most dangerous lie. The credit score was never designed to measure your financial health or your wealth. It was designed to measure how profitable you are to the banking system. When you understand that you are not the player, but the product, the confusing mistakes that ruin scores suddenly make perfect sense. If you are not paying interest, you are not useful. This is why the way you handle your credit cards right now might be secretly flagging you as a high-risk customer, even if you have never missed a payment in your life. One of the most common traps people fall into is the obsession with the 30% rule. You have probably heard it 1,000 times. Keep your credit card balance below 30% of your limit. While this advice prevents you from disaster, it keeps you in mediocrity. The algorithm doesn't want you to be average. If you have a limit of $10,000 and you are constantly using $3,000, you look like someone who relies on debt to survive. The highest achievers, the ones with the perfect scores, don't aim for 30%. They aim for 1 to 3%. They use the card enough to show activity, but pay it down before the statement even closes, tricking the system into thinking they have almost infinite liquidity. Then there is the silent killer of credit scores, the mistake that feels like a smart minimalist move: closing old accounts. You look at your wallet and see a credit card you haven't used in 5 years. It has a low limit, no rewards, and feels like clutter. So you call the bank and cancel it. In your mind, you are simplifying your finances. In the algorithm's eyes, you just erased a massive chunk of your history. Your score relies heavily on the average age of your accounts. By cutting off that old card, you suddenly look like a new, unproven borrower. It is like deleting the first half of your resume and wondering why you didn't get the job. But it gets even more twisted when we look at how you handle payments. There is a terrifying difference between statement balance and the current balance, and ignoring it is costing you points every month. Most people set up auto pay for the due date and forget about it. The problem is that credit card companies report your balance to the bureaus a few days before that due date, usually when the statement closes. So, even if you pay in full every month, the snapshot the bureau sees might show a maxed-out card. You are paying off the debt, but the record shows you as a desperate borrower maxing out your limits. You are technically debt-free, but digitally, you look like a risk. This leads us to the most counterintuitive trap of all, the one I mentioned at the start: paying off installment loans too quickly. When you have a mortgage or a car loan, that account adds diversity to your credit file. It shows you can handle long-term commitments. When you pay it off early, the account eventually closes. You lose the diversity, you lose the active history, and your score drops. The system prefers a person who stays in debt for the full term over someone who has the cash to escape it. It rewards endurance, not freedom. Another subtle error is the shopping around fallacy. You want a new car or a mortgage, so you apply at 5 different places over 2 months to compare rates. Logically, this is smart consumer behavior. You are hunting for the best deal. However, if you don't do this within a very specific, short time window, the system treats each application as a separate, desperate plea for money. These hard inquiries stack up. A person asking for money once is a customer. A person asking for money 5 times in different months is a crisis waiting to happen. The algorithm lacks nuance. It only sees the frantic behavior of someone looking for cash. Now consider the climax of this entire system, the truth that connects all these mistakes. The credit score is essentially a trust metric, but not the kind of trust you think. It is not about trusting you to have money. It is about trusting you to play the game of debt. The reason a billionaire who pays cash for everything can have a ghost score of 0 is that they don't participate. The system is rigged to favor those who walk the razor's edge, using debt constantly, but never letting it consume them. You are being scored on your ability to manage a product that is designed to extract wealth from you. The perfect borrower in the eyes of the algorithm is not the one who is free, but the one who is reliably bound to the system. So, as you look at your financial life, you have to ask yourself a difficult question. Are you trying to build real wealth, or are you just trying to win a gold star from the very institutions that profit from your debt? Because sometimes the price of a perfect score is your own financial freedom. Which one are you actually chasing?